Greetings and salutations, my friends. I am Mr. Darston, and welcome once again to In the Money with Mr. Darston. Please don't forget to like and subscribe to keep getting great content like we're going to delve into today. Over the course of the next few videos, we'll be discussing the three I's: inflation, interest rates, and investing. But for the duration of this video, our main focus is going to be on that first one, inflation, and how it affects your investing strategy. Let's start by addressing inflation, what it is, and how it affects each of us. Now, a broad definition defines inflation as the rate of increase in prices over a given period of time. What that does, it typically measures the overall increase in prices in a region such as a country that ties into how much it costs you to live, or basically, in a nutshell, an increase in the cost of living. Looking at it from a monetary perspective, inflation is the rate at which the value of a currency is falling, and consequently, the general value of prices for goods and services is rising. So basically, as your cost of living increases, what you see happening to the currency is a sort of a devaluation. When we talk about inflation, a term that typically comes up is the CPI, the Consumer Price Index. What the CPI is most used for is a measure of inflation, and it also helps us to uh, get an indication of the effectiveness of our government's economic policies. Now, by definition, the CPI is a monthly measure of the average change over time in the prices paid by consumers for a market basket of consumer goods and services. As inflation increases, you and I feel the effects of it by virtue of the fact that our money loses value. Specifically, how are you and I affected, you ask? Well, from March of 2021 to March of 2022, the CPI showed that inflation jumped to a whopping 8.5% over that year's time. Now, that happens to be the highest jump in about 40 years. And what that means for us is that the price of an item in that basket of goods we discussed is now almost 10% higher this year than it was before. So for you and I, now we must either find a job or get a raise at our current job that pays us 8 to 10% more this year than we made in the past, or we find ourselves being poorer and able to buy less stuff with the money we currently have. As inflation begins to affect the price we pay for things, and the fear that it will continue to perhaps grow permeate the news, we see certain effects from a national level. One of the things that transpires is that there tends to be a run on food and fuel necessities because the thought is we need to stock up now before prices continue to increase. That only causes prices to increase more. To combat inflation, nations will often resort to constricting the money supply. That typically entails a central bank raising interest rates and curtailing spending to get less dollars floating around in the economy, thus increasing the value of the dollar. Though these actions historically have proven to curtail the rising effects of inflation over time, in the immediate impact, what we feel as consumers are things like higher interest rates on loans. So it's a little more difficult to get that new car, to finance that new home, as the cost of borrowing money increases. This increase in the cost of borrowing money often hurts growth and makes it more difficult for startups to get the investment capital they need to really boom. So, what we often see in the stock market is a decrease in the value of growth in technology sector stocks during a time of high inflation. Let's talk about a concept that's known as the time value of money. And it's the concept that the money you have now is worth more than the identical amount of money at some future date due to the potential you have today of letting your money earn over time. In other words, if you invest your money today, it'll be worth a lot more tomorrow. Now, if you decide, I don't want to risk the money in the market, I'm not going to invest it, I'll just put it away in a bank, piggy bank in this instance. You guarantee yourself that you'll have $100 in 15 years. But what will that $100 be worth? Now let's do a thought experiment. Let's say today you're given $100 and you're asked to buy groceries with those $100. I'm sure you can probably buy a sufficient amount of groceries right now to satisfy yourself for maybe a few days, even up to a week. Now, let's say the thought experiment was to last for 15 years, and 15 years later, you were given $100 and asked to buy groceries then. Now, after the 15 years has passed, let's say you still have $100. Will $100 in 15 years buy what it can buy today? Of course it won't. That is why it's so important that when you have that $100 today, you do something with it so that it grows in value, so that it can get the things you're going to need in the future. Now, what we've just described with $100 losing purchasing power over time is the effect of inflation. What has been the best combatant against inflation historically has been investing over the long term in equities or stock-based market investments. This is a way to grow your wealth and combat the negative effects of inflation. This chart represents the real-world performance of the S&P 500 index. Now, the S&P 500 index is an index that many refer to when they speak of the market. So, here, our date range starts on October 9th, 2007. On that day, the market was at an all-time high. Let's say you were unlucky enough to invest your money on that date. Let's watch what happened. Almost immediately, the value of the investment began to drop. We had the housing crisis. We had the bailouts. We had so much going on from late '07 through 2009 that the account went from $100,000 to as low as $59,000. Pretty scary, huh? But remember, we have time on our side. So let's take a look at what happened as time progressed. Time went on, and the account recovered from the low 50,000 range to as high as $265,000 in 2009. I'm sorry, 2019. Then again, remember, you're very unlucky. You take the money out in 2020. Coronavirus, the worst possible date being March 23rd. Look at your value though. Over the nearly 13 years that you've been invested, your value has gone up from a starting amount of $100,000 to around $185,000. Quite an increase considering especially the fact that you invested on the worst possible startup day and you took your money out at the worst possible time, right before a global pandemic. Even in this scenario, you still made loads of money. Would that have happened in a bank? The answer, of course, is a resounding no. Inflation would have eaten away at the value of that $100,000 you initially started with 13 years ago. And now you still have $100,000, but it wouldn't go as far. It would have been depleted and you'd be able to buy less. Whereas if you'd invested it and now it's worth closer to $200,000, you can still buy all the things you could have afforded 13 years ago and still have a little bit more wealth on top of that. The various sectors you can invest in include things like energy, technology, even fixed income. There's commodities, among many others. Using various sectors and diversifying across asset classes of large companies, small companies, medium-sized companies, international companies, and domestic companies can help mitigate risk and make sure you don't end up stuck with one bad investment. The way to use this information to help build a solid portfolio would be to pick various investments that represent different asset classes. One of your investments could be a large cap growth fund. Another could be a small cap growth fund. One can be an international investment. Another can be a domestic fixed income investment. Picking different types of asset classes like this will protect your portfolio from fluctuations. Though your portfolio will still have its ups and downs, Those drastic shifts, those major fluctuations that occur when one sector goes belly up will not impact your portfolio as adversely. We know that inflation will impact us in an immediate sense. In the short term, we're going to pay more for gasoline. We're going to pay more for groceries. We're going to pay more for those daily necessities that make up that uh, cart that we discussed. However, when taking a long term approach, the best way again to make sure that your money and your wealth lasts is to invest that money to outpace inflation. If you're looking for more detailed information and you'd like to enroll in one of our courses that will help you become a money master, please visit us at mrdarston.podia.com/join now. I look forward to teaching you all that I can to help you become a money master. Thank you. Have a wonderful afternoon.